Welcome to this explainer for the Seng Tech Weekly. We're tracking a massive systemic shift that's underway right now across 16 major tech companies. It's a fierce pivot toward artificial intelligence and sovereign hardware. And as we're going to see, the world's biggest tech giants are making some aggressive, margin-crushing bets to get there. So here's our agenda for today. First, AI squeezes tech earnings. Second, the sovereign silicon hardware boom. Third, EVs pivot to intelligence. Fourth, digital ecosystems and gaming. And finally, the AI IPO rush. All right, part one, AI squeezes tech earnings, investing for tomorrow. Okay, so Alibaba is actually intentionally taking a massive hit to its current margins. They just posted an 84% drop in adjusted EBITDA, which is their core operating profit, along with an 848 million RMB operating loss. That's actually their first loss since 2021. But wait, look at the payoff. Cloud intelligence external revenue is up 40%. CEO Eddie Wu explicitly stated they're building parallel factories for AI training and inference. And get this, they don't have a single idle card on their servers right now. They're literally trading today's margins for tomorrow's AI dominance. Now, Meituan is facing a similar kind of margin pressure, but for slightly different reasons. Their core local commerce segment swung to a 2 billion RMB operating loss because they absorbed a massive 51% surge in marketing spend. They're basically defending their market share in a really brutal, localized price war. But looking at the whole picture, overall revenue actually rose 5.6%, completely beating expectations. They're using their massive scale to offset these subsidy wars, all while heavily investing in physical AI, like their automated drone delivery network, which just blew past an incredible 900,000 commercial orders. Kuaishou is going through a really fascinating transition right now. Their live streaming revenue is actually shrinking, down 13.5%, because they're actively cutting out low-quality content. Instead, they're pouring funds into their Kling AI video generation model. Now, sure, that caused an overall 26.3% drop in adjusted net profit, but it's fueling a 15.9% growth in their other services category. It's pretty much a textbook quality over quantity pivot. Rounding out the earnings picture, JD.com saw their net profits drop 53% as they aggressively invest in European delivery infrastructure and automated fulfillment. Meanwhile, Baidu is looking right past the current margin valley. Their finance chief is officially forecasting healthy, AI-driven revenue growth on the horizon. The through line here is absolutely clear. Cash is being relentlessly plowed back into AI and logistics. Moving right along to Section 2, Sovereign Silicon Hardware Boom, Reshoring the Future. The really crucial point here is this massive number, over 17.3 billion Hong Kong dollars. That is the net southbound capital, meaning mainland Chinese investors pouring money across the border, that flowed into SMIC in May alone. SMIC stock surged 15% for the month, really cementing its status as the manufacturing cornerstone for domestic technology. As geopolitical restrictions push China toward semiconductor independence, SMIC is the vital foundry supplying the 7-nanometer chips that make this entire ecosystem run. And you know who's reaping the direct rewards of this infrastructure surge? Lenovo. Their stock literally doubled in May. They posted Q4 revenue of $21.6 billion, which is up 27% year over year. And why is that? Because they are sitting on an absolutely staggering $21 billion AI server backlog. They literally cannot build them fast enough. To meet this insane demand, they just partnered with the Tianjin government to spin up a brand new AI compute fabrication plant slated for 2027. Okay, Section 3. EVs pivot to intelligence, beyond the price war. When we look at the May delivery numbers across the major players, BYD managed to flatten its 8-month sales decline, while NIO surged with a multi-brand expansion. But the real takeaway here is the strategic focus. Companies like Xiaomi are launching premium GT models to elevate their average selling prices, while Li Auto is actively tweaking its physical hardware layouts. For instance, they're shifting the L8 from 6 seats to 5, specifically to defend market share and prevent cannibalizing their own L9 sales. Now, BYD isn't just selling cars anymore. They're basically selling rolling supercomputers. They just unveiled their self-developed 4-nanometer Xuanji A3 chip, pushing incredible computing power right to the edge. But here is the genius move. To get people to actually trust and use this tech, BYD is boldly offering full financial damage coverage for autonomous driving accidents. If you're legally using their Urban Navigate on autopilot system and the car crashes, they pay for it. Talk about putting your money where your microchip is. That is exactly how you build absolute consumer trust in a brand new technology. Meanwhile, Xiaomi is leveraging share buybacks to support their stock amid short-term margin pressures, all while rolling out their new HyperOS 3 system. The overarching goal here is a seamless software bridge connecting your smartphone, your home appliances, and your EV. On the autonomous front, XPeng is pushing the limits by rolling out their new mapless L4 robotaxis, meaning fully autonomous, driverless operation in specific areas, and it's powered by 4 dedicated Turing AI chips. The hardware is really finally catching up to the software dreams. Let's jump to Section 4, Digital Ecosystems and Gaming Global Expansion. Tencent just held its massive Spark 2026 showcase, revealing 45 major updates. They are seamlessly blending the digital and physical realms right now. For example, they've launched a huge, real-world, arcane immersive theater experience in Shanghai, and they're ticketing it directly through Trip.com. On the digital side, they launched Chaos Zero Nightmare and unveiled Digital Jing Dezhen, which is a beautifully crafted AI-powered porcelain simulation game. This isn't just gaming anymore. It's using AI, digital humans, and 3D generation to actually preserve ancient real-world crafts. Now, take a second and look at this figure, $3.7 billion. That is NetEasy's Q1 gaming revenue alone. It represents a very steady 6.9% increase, driven largely by the strong performance of their self-developed titles and continuous content updates. However, despite that massive revenue, NetEase is exercising incredibly strict capital discipline. They actually recently opted to completely pull funding and cancel Nagoshi Studios' debut overseas game. Why? Because finishing it would have required sinking another $44.4 million. In this current macroeconomic climate, even the biggest gaming giants are ruthlessly cutting their losses to ensure high capital efficiency. And finally, Section 5, the AI IPO rush, the next generation. Okay, let's dive into this fascinating race. China's foremost AI unicorns, Zhipu AI and Minimax, are aggressively pushing to the public markets. Zhipu briefly flirted with a staggering 800 billion Hong Kong dollar market cap and is pushing for a Shanghai listing, while Minimax has officially submitted filings for domestic A-share guidance. The reality is, they absolutely have to go public to secure the billions in capital required to continuously train their large language models. The private markets simply aren't deep enough for them anymore. And these software AI models are going to be supported by an influx of domestic hardware capital. Memory giant CXMT just cleared what's going to be the second largest IPO in the history of the STAR market, China's tech-heavy exchange, targeting a 29.5 billion yuan raise. They're joining YMTC, which is also currently in pre-IPO tutoring. The capital markets are being aggressively mobilized to fund sovereign silicon independence. As we wrap up this explainer, I want to leave you with a vital question. We are watching companies willingly destroy their short-term profits to buy servers, train models, and build domestic foundries. Will these intense, margin-crushing investments forge the world's next AI and hardware superpowers? Or will the sheer financial burden of this transition prove just too heavy to carry? Honestly, it's the multi-trillion-dollar question that's going to define the next decade of tech. Thanks for joining me today, and as always, keep your eyes on the data.